Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a Loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to directly address something that many Canadian politicians and the media are having trouble reconciling. That Canada is a quasi-petrostate and the Loonie remains a Petro-currency. For many years now, Canadian leaders and the media have tripped over themselves to attack and deride Canada's oil and gas industry, going so far as to announce that Canada is essentially a post-oil economy. The examples are too numerous to count, but a quick Google search of the last decade exposes a litany of grand claims from Trudeau to Singh, anti-oil activists, and the media shills from coast to coast. But my sharpest criticism is reserved for those in Canada's finance and banking sector who should have known better, but instead regurgitated this nonsense knowing full well global oil consumption is expected to rise for decades. Canada is the fourth largest producer of oil in the world, and we have the third largest oil reserves. But first, there's nothing like a little trade war to focus the mind. In last week's episode, we argued that Trump's tariffs were not about economics, but about Canada's security failings and rare earth minerals and metals. We may yet be proven wrong about this, but to date, we still hold that view. What is interesting, however, is how quickly dirty Alberta oil became Canada's energy, a weapon now expected to be used in this trade war. Only a mix of ignorance and hubris could sustain such a view. Some politicians even went on to say that we should have built more pipelines in order to access other markets, after spending their entire political career opposing such investments. Canadians should be outraged, both at the economic ignorance and the rank, self-serving nature of the comments. The reason the view that oil and gas can and should be shut off and used in a trade war is to some degree based on the following notion, that natural resources are a fraction of GDP. And indeed, the chorus of media members saying so are right. The vast majority of Canada's economy is not oil. What's more is that there's not that many people working in the energy sector. But those who follow me on Twitter or heard me on the Loonie Hour or watch these videos know what I'm about to say next. It's not about GDP or employment. It's about the current account balance. A current account balance, in simple terms, is about money flowing in versus money flowing out. This includes trade in goods and services and financial flows like dividend payments from overseas investments. The importance of a current account balance also lies in its role as an indicator of an economy's structure, competitiveness, and its potential vulnerabilities. Any massively negative deficit must be financed with foreign monies, and if it's too large or unsustainable, it will get corrected, sometimes painfully so. This happens through an internal valuation, less consumption, or an external valuation, a much lower exchange rate, higher inflation, and ultimately less consumption. And you will note from the chart that Canada's current account balance is roughly in balance. However, Canada is one of the most indebted countries in the world, mired in a productivity emergency, as the BOC's words, and the idea that shutting down oil exports would result in just a few jobs lost and a bit of GDP gone is a childish and dangerous notion that should be forcefully rejected. So because consumption is a much slower boat to turn around, what would happen if Canada turned off the taps, and why? Well, the Loonie would very likely collapse, and this is because the Canadian dollar remains a petro-currency. The following chart is of oil prices in a basket of major currencies excluding the US dollar. We'll get to that in a second. This simplified illustration proves an important point. The Loonie moves lockstep with crude oil prices, i.e. it is a petro-currency. Stop pumping and the weak fundamentals of the Canadian economy will take hold and drag the Loonie lower. The natural follow-up question is, what about the US dollar? Well, historically, there's been a strong correlation between the US-Canadian exchange rate and oil. But in recent years, the U.S. oil production has exploded, and the U.S. has reduced its reliance on oil imports. Ergo, our currency pair is less sensitive to the machinations of the oil price. Again, this is an oversimplification. Other factors like productivity, capital flows, and growth play their part, but you get the idea. So if the US produces so much oil, what do they need Canada's for? Well, not all oil is created equal. US production is dominated by lighter, sweet crude oil, and thus they have to import heavy crude oil. This is exactly the type of oil Canada has. And this 4.5 million barrels of oil Canada produces per day is transported via pipeline to the major refineries in the Midwest and other parts of America that are specifically designed to process this oil into useful products. The mix is crucial for the multitude of products required in this refining process. For the U.S. to replace this with imports from other countries is nearly impossible, or would take an incredible amount of time and money, and thus would destabilize key economic infrastructure and a finely tuned oil market. Similarly, Canada can indeed find other markets via pipeline, east or west, but it would take years, and Canadian politicians have worked tirelessly to block these investments seemingly at every turn. This brings us to the nature of the U.S. trade deficit with Canada, something we discussed last week, and why we remain sanguine with respect to the tariff threat. The U.S. sells Canada billions worth of goods and services and buys Canadian oil. For Trump to effectively tax imports of a critical economic input simply doesn't stand to reason, and, as we've argued last episode, suggests there's something else afoot. As we end this week's video, I want to walk you through some key facts that will probably not change in our lifetime. 1. Global oil demand is here to stay, and only the most conservative and politically captured projections from the IEA, for example, say otherwise. 2. Canada has the third largest oil reserves in the world, after Venezuela and Saudi Arabia. 3. Canada is the fourth largest producer of oil, although we tend to jockey for this position with China, Iraq, and Iran. 4. Canada's oil consumption has been steady for 20 years, or at around 2.5 million barrels of oil per day. And this leads us to our most important fact of the day. The difference between our consumption of oil and our production of oil means that we have a massive energy surplus, the third largest in the world after Russia and Saudi Arabia. This massive surplus is not just about oil specifically, but about energy. And this energy can be used for all kinds of industrial applications, and ultimately, it is a massive source of wealth that can be directed in a multitude of different directions. All right, so that's a wrap on this week's episode. Thank you again for listening. Please like, subscribe, and follow for more. And as always, we manage money for families around the world and Canada, so please feel free to get in touch.